Welcome to Prep Pass. Here are 50 real-life and health insurance license practice questions with answers for 2026. Read each question, then try to answer before the 5-second timer runs out. For the full free practice test, just search preppass.org. Let's begin. Question 1. A consumer enrolls in a California Health Maintenance Organization, HMO. Which state agency has primary regulatory authority over that HMO? A. California Department of Insurance, CDI. B. California Department of Managed Healthcare, DMHC. C. California Department of Public Health, CDPH. D. Centers for Medicare and Medicaid Services, CMS. The correct answer is B. Under the Knox-Keene Healthcare Service Plan Act, California HMOs are regulated by the Department of Managed Healthcare, DMHC, not the CDI. The CDI regulates indemnity health insurance and PPO products, but full-service HMOs fall under DMHC. Question 2. Which California law sets the standardized required and optional provisions that every individual accident and health policy must follow? A. The Holden-Bagley Act. B. The Knox-Keene Healthcare Service Plan Act. C. The Uniform Individual Accident and Sickness Policy Provisions Law, UPPL. D. The California Long-Term Care Insurance Act. The correct answer is C. The UPPL, codified beginning at Cal. INS Code Section 10350, divides ANH policy language into required and optional provisions. Knox-Keene governs HMOs, Holden-Bagley addresses life and disability, the LTC Act covers long-term care contracts. Question 3. An agent tells a prospect that a competing insurer is on the verge of financial collapse in order to convince the prospect to buy from her own company. The competitor is in fact solvent. Under the Unfair Practices Act, this conduct is best described as A. Twisting, because it involves a misrepresentation about another insurer. B. Defamation of an insurer, because it makes a false statement injuring the reputation of another insurer. C. Boycott or coercion, because it pressures the consumer. D. Permissible competitive speech, because no contract has been signed. The correct answer is B. Cal. INS Code Section 790.03 B defines defamation as making, publishing, or circulating any false statement that is calculated to injure any person engaged in the business of insurance. False statements about a competitor's solvency fall squarely within this definition, regardless of whether a sale results. Question 4. Which definition of total disability is the most favorable to the insured? A. Own occupation. B. Any occupation. C. Modified own occupation. D. Gainful occupation. The correct answer is A. Under an own occupation definition, the insured is totally disabled if they cannot perform the duties of their specific occupation, even if they could work in another field. This is the most favorable test because it allows benefits to continue even when the insured can earn a living in some other line of work. Question 5. Under a group life insurance plan sponsored by an employer, who holds the master contract and who receives a certificate of insurance? A. Each employee holds the master contract, the employer receives the certificate. B. The employer holds the master contract, each covered employee receives a certificate of insurance. C. Both employer and employees hold copies of the master contract. D. The insurer holds the master contract, the employer receives the certificate. The correct answer is B. In group life insurance, the sponsoring employer, or association, is the policy owner and holds the single master contract. Each insured employee receives only a certificate of insurance summarizing coverage, beneficiary, and conversion rights. Question 6. Which characteristic best distinguishes term life insurance from whole life insurance? A. Term insurance builds tax-deferred cash value. B. Term insurance provides coverage for a stated period with no cash value. C. Term insurance guarantees coverage to age 121. D. Term insurance allows the policy owner to take policy loans. The correct answer is B. Term insurance is pure protection. It pays a death benefit only if the insured dies during the term and accumulates no cash value. Cash value, lifetime coverage, and policy loans are features of permanent products such as whole life. Question 7. Under the incontestability clause required in California life policies, after how many years from the date of issue can an insurer no longer contest the policy except for fraud or non-payment of premium? A. 1 year. B. 18 months. C. 2 years. D. 3 years. The correct answer is C. California requires every life insurance policy to be incontestable after it has been in force during the lifetime of the insured for 2 years from its date of issue, except for non-payment of premium and certain fraud-related defenses. Question 8. Under the California Insurance Code, insurance is best described as which of the following? A. An investment vehicle that guarantees a return on premium. B. A contract whereby one party undertakes to indemnify another against loss from a contingent event. C. A government program that pays benefits to all residents. D. A savings account that accumulates tax-free interest. The correct answer is B. Cal. Ins. Code Section 22 defines insurance as a contract whereby one undertakes to indemnify another or pay a specified amount upon determinable contingencies. It is not an investment guarantee, a government program, or a savings account. Question 9. Which part of Medicare primarily covers inpatient hospital stays, limited skilled nursing facility care, and hospice? A. Part A. B. Part B. C. Part C. D. Part D. The correct answer is A. Part A is hospital insurance. It covers inpatient hospital stays, limited skilled nursing facility care after a qualifying hospital stay, hospice, and some home health. Part B covers outpatient and physician services. Question 10. How is a lump sum life insurance death benefit paid to a named individual beneficiary treated for federal income tax purposes? A. Generally excluded from the beneficiary's gross income. B. Taxed as long-term capital gain. C. Taxed as ordinary income to the extent it exceeds premiums paid. D. Subject to a 10% additional tax if the beneficiary is under 59.5. The correct answer is A. IRC Section 101A excludes amounts paid by reason of the insured's death from the beneficiary's gross income. Interest credited after the date of death on installment payouts is the only piece that becomes taxable. Question 11. Under the Federal Affordable Care Act, a non-grandfathered group health plan must cover recommended preventive services with A. A separate $100 deductible. B. The same co-insurance applied to specialty care. C. No cost sharing to the in-network member. D. A flat $25 copayment per visit. The correct answer is C. Section 2713 of the Public Health Service Act, added by the ACA, requires non-grandfathered plans to cover certain preventive services, such as immunizations, screenings, and annual wellness visits, without imposing any deductible, copayment, or coinsurance when delivered in-network. Question 12. Under the time limit on certain defenses provision, after how many years from issue can the insurer no longer rescind an A&H policy for a non-fraudulent misstatement on the application? A. 1 year. B. 2 years. C. 3 years. D. 5 years. The correct answer is B. The incontestability window for individual A&H policies is 2 years from the date of issue. After that, only fraudulent misstatements remain contestable. Ordinary errors no longer support rescission. Question 13. Which of the following actions by an insurer would constitute an unfair claims settlement practice under California law? A. Requesting reasonable proof of loss before paying a claim. B. Promptly investigating a claim after notice is received. C. Failing to acknowledge and act reasonably promptly upon communications with respect to claims. D. Offering settlement based on a properly conducted investigation. The correct answer is C. Section 790.03, H2. Lists failing to acknowledge and act reasonably promptly on claim communications as one of the enumerated unfair claims settlement practices. The other options describe lawful, expected insurer conduct. Question 14. An insured selects a 180-day elimination period instead of a 30-day elimination period. What is the effect on the premium? A. The premium increases because benefits will be paid longer. B. The premium is unchanged. The elimination period does not affect cost. C. The premium decreases because the insurer's exposure is reduced. D. The premium decreases only if the benefit period is also shortened. The correct answer is C. The elimination period is the waiting time before benefits begin. A longer elimination period means the insurer pays for fewer disability claims and pays each one later, which reduces the insurer's overall exposure and lowers the premium. Question 15. An employee with $100,000 of group term life coverage is terminated. How long does she have to convert to an individual permanent policy without proof of insurability? A. 10 days. B. 21 days. C. 31 days. D is 60 days. The correct answer is C. California Group Life Law requires a 31-day conversion privilege following termination of group coverage. The departing employee may convert to an individual permanent policy at her attained age with no evidence of insurability. Question 16. A homeowner buys a 30-year policy where the premium stays level but the face amount declines each year along with the mortgage balance. This is best described as A. Annual renewable term. B. Level term. C. Decreasing term. D. A return of premium term. The correct answer is C. Decreasing term holds the premium level while the face amount drops over time. It is commonly aligned with a declining mortgage balance, so the death benefit pays off what is left on the loan. Question 17. What is the free look period that California requires on a life insurance or annuity policy issued to a senior age 65 or older? A. 10 days. B. 30 days. C. 20 days. D. 15 days. The correct answer is B. While standard individual life policies must give at least a 10-day free look, California requires a 30-day free look period when the policy is issued to an applicant 65 or older. Question 18. Which of the following is an example of a pure risk that an insurer would accept? A. Buying stock in a technology startup. B. Opening a new restaurant in a competitive market. C. The possibility that an insured will die during the policy term. D. Betting on the outcome of a sporting event. The correct answer is C. Only pure risk, which involves the chance of loss or no loss with no opportunity for gain, is insurable. Investments, business ventures, and gambling are speculative risks because they include a chance of gain and are not insurable. Question 19. A 67-year-old beneficiary needs durable medical equipment ordered by her doctor. Which part of Medicare pays for it? A. Part A. B. Part B. C. Medigap Plan F. D. Part D. The correct answer is B. Part B is medical insurance and covers outpatient services, physician visits, preventive care, and durable medical equipment. Part A is for inpatient hospital services. Question 20. What test determines whether a permanent life insurance policy is classified as a modified endowment contract, MEC? A. The corridor test. B. The cash value accumulation test. C. The 7-pay test. D. The guideline premium test. The correct answer is C. Under IRC Section 7702A, a contract becomes a MEC if cumulative premiums paid in any of the first 7 contract years exceed the 7-pay premium limit. The corridor and CVAT/GPT tests instead determine whether a contract qualifies as life insurance under Section 7702. Question 21. An employee voluntarily quits her job at a private company with 60 employees. Under Federal COBRA, the maximum continuation coverage period available to her is A. 18 months. B. 29 months. C. 36 months. D. 60 months. The correct answer is A. Voluntary or involuntary termination, other than for gross misconduct, and reduction in hours are qualifying events that entitle a covered employee to up to 18 months of COBRA continuation. The 29-month period applies only when the qualified beneficiary becomes disabled, and 36 months applies to dependent events such as death, divorce, or loss of dependent status. Question 22. Sergio's individual health policy was issued 4 years ago. The insurer discovers that on the application he deliberately concealed a prior cancer diagnosis to obtain coverage. May the insurer rescind the policy? A. No, the 2-year contestable period has passed. B. No, the 3-year contestable period has passed. C. Only if the misstatement was material to the loss. D. Yes, fraudulent misstatements may be contested at any time. The correct answer is D. The incontestability provision does not protect fraudulent statements. Even after the 2-year window, an insurer may rescind a policy issued in reliance on a deliberately false answer. Question 23. An agent convinces a policyholder to surrender an existing whole life policy and buy a new one, primarily to earn a fresh first-year commission, even though the change disadvantages the client. This practice is known as A. Twisting, B. Sliding, C. Rebating, D. Commingling. The correct answer is A. Twisting is inducing a policyholder to lapse, surrender, or replace a policy through misrepresentation or incomplete comparison. When done repeatedly within the same insurer's book of business, it is called churning. Both are prohibited by California law. Question 24. Why do disability income insurers cap the monthly benefit at roughly 60 to 70% of the insured's gross income? A. Federal law forbids replacing 100% of income. B. To preserve the insured's financial incentive to return to work. C. Because state guarantee funds will not cover higher amounts. D. Because the IRS taxes any benefit above that level. The correct answer is B. Insurers limit the benefit so that the insured still has a real financial reason to recover and return to work. Paying close to or more than full income would invite malingering and adverse selection. Question 25. Under Internal Revenue Code Section 79, how much employer-paid group term life coverage on an employee is excluded from the employee's taxable income? A. The first $50,000. B. The first $25,000. C. The first $100,000. D. All employer-paid coverage regardless of amount. The correct answer is A. Section 79 excludes the cost of the first $50,000 of employer-paid group term life coverage from the employee's taxable income. The cost of coverage above $50,000, calculated from IRS Table I, is imputed income on the employee's W-2. Question 26. What is the main advantage of the convertible feature in a term life policy? A. The policy owner may exchange the term policy for a permanent policy without proof of insurability. B. The policy owner receives all premiums back at the end of the term. C. The premium decreases each year as the insured ages. D. The death benefit increases automatically with inflation. The correct answer is A. Convertibility lets the policy owner exchange the term contract for permanent insurance, typically whole life or universal life, without a medical exam or new evidence of insurability. This protects an insured whose health has worsened. Question 27. The entire contract clause in a California life policy means that the policy contract consists of which of the following? A. The policy only. B. The policy and the agent's sales illustrations. C. The policy and the insurer's underwriting manual. D. The policy together with the attached written application. The correct answer is D. Under the entire contract provision, the policy and the application attached to it constitute the entire contract between the parties. Verbal statements, sales illustrations, and underwriting manuals are not part of the contract. Question 28. Which mathematical principle allows insurers to predict losses accurately enough to set fair premiums? A. Law of diminishing returns. B. Principle of indemnity. C. Doctrine of adhesion. D. Law of large numbers. The correct answer is D. The law of large numbers states that as the number of similar exposures grows, actual losses converge on the predicted average. This lets actuaries set premiums that cover expected claims. Indemnity and adhesion are contract doctrines, not predictive tools. Question 29. Medicare Advantage plans are also known as which part of Medicare? A. Part A. B. Part B. C. Part C. D. Medigap. The correct answer is C. Part C, called Medicare Advantage, is offered by private insurers that contract with CMS to deliver all Part A and Part B benefits and usually drug coverage as well. Medigap is supplemental, not part of Medicare itself. Question 30. How is a partial withdrawal from a non-MEC permanent life insurance policy taxed? A. Gain comes out first as ordinary income, LIFO. B. A basis comes out first tax-free, FIFO, then gain as ordinary income. C. The entire withdrawal is income tax-free up to the cash value. D. The withdrawal is treated as long-term capital gain. The correct answer is B. IRC Section 72, E-5, gives non-MEC life insurance FIFO ordering. The owner first recovers premiums paid, basis, tax-free, and only amounts above basis are taxed as ordinary income. MEC contracts use the opposite LIFO ordering. Question 31. CalCobra differs from Federal Cobra primarily because it A. provides longer benefits to employees of large employers. B. replaces Federal Cobra for all California residents. C. eliminates the employee premium contribution requirement. D. extends continuation rights to employees of small employers with 2 to 19 employees. The correct answer is D. Federal Cobra applies only to employers with 20 or more employees. CalCobra fills the gap by requiring continuation coverage from California group health plans of small employers with 2 to 19 employees, generally for up to 36 months total. Question 32. An individual A&H policy is paid on a monthly mode. What is the length of the required grace period? A. 10 days. B. 7 days. C. 20 days. D. 31 days. The correct answer is A. The standard grace period is 7 days for weekly mode, 10 days for monthly mode, and 31 days for all other modes. Coverage continues during the grace period. Question 33. Which of the following describes rebating? A. reducing premium by applying earned policy dividends. B. offering a group discount lawfully filed in the rate plan. C. sharing commission with a co-licensed agent of record. D. returning part of the agent's commission to the applicant as an inducement to buy. The correct answer is D. Rebating is offering any valuable consideration outside the policy as an inducement to buy. California now permits limited, non-discriminatory rebates if disclosed and offered uniformly, but the textbook definition tested here is the unlawful inducement form. Question 34. A short-term disability policy sold through an employer is most likely to pay benefits for which length of time? A. 1 to 2 days. B. 12 to 24 months. C. 5 years up to age 65. D. 3 to 26 weeks. The correct answer is D. Short-term disability policies typically pay benefits for 3 to 26 weeks after a short elimination period of 0 to 14 days. Long-term disability picks up after short-term ends and may pay for years. Question 35. Which federal agency has primary responsibility for enforcing ERISA's fiduciary, disclosure, and reporting rules for employer-sponsored benefit plans? A. The Securities and Exchange Commission, SEC. B. The Internal Revenue Service, IRS. C. The Federal Trade Commission, FTC. D. The U.S. Department of Labor, DOL. The correct answer is D. ERISA is administered chiefly by the U.S. Department of Labor through its Employee Benefits Security Administration. The IRS handles tax qualification of pensions and the PBGC ensures certain defined benefit pensions, but frontline fiduciary and disclosure enforcement is DOL. Question 36. Sarah purchases a 20-pay whole life policy at age 30. Which statement is correct? A. She must pay premiums until age 100. B. Coverage ends 20 years after purchase. C. She pays no premium at all and the policy is self-funding. D. Premiums are paid for 20 years. Coverage continues for the rest of her life. The correct answer is D. Limited pay whole life concentrates the lifetime cost of the policy into a shorter premium paying period. With 20 pay whole life, Sarah pays for 20 years and then the policy is paid up, but coverage continues for her entire life. Question 37. What is the typical grace period required in a California individual life insurance policy for payment of an overdue premium without lapse of coverage? A. 10 days. B. 20 days. C. 31 days. D is 60 days. The correct answer is C. California life policies must include a grace period of at least 1 month, typically 31 days. During this period the policy remains in force, and if death occurs, the unpaid premium is deducted from the proceeds. Question 38. An applicant for life insurance has uncontrolled high blood pressure. This condition is best classified as which type of hazard? A. Physical hazard. B. Moral hazard. C. Immoral hazard. D. Illegal hazard. The correct answer is A. A physical hazard is a tangible condition that increases the chance of loss, such as high blood pressure, obesity, or a slippery floor. A moral hazard involves dishonesty, a moral hazard involves carelessness because of insurance, and a legal hazard arises from the legal environment. Question 39. Which part of Medicare provides standalone prescription drug coverage? A. Part A. B. Part B. C. Medigap Plan G. D. Part D. The correct answer is D. Part D is the prescription drug benefit. It is sold by private insurers and requires the beneficiary to have Part A or Part B to enroll. Medigap policies sold today do not include drug coverage. Question 40. An owner age 50 takes a $10,000 distribution from a modified endowment contract that has $4,000 of gain over basis. What federal tax result generally applies? At $0 taxable, no penalty because life insurance is exempt. B. $10,000 taxable as ordinary income, no penalty. C. $4,000 taxable as ordinary income, no penalty because the owner is under 65. D. $4,000 taxable as ordinary income plus a 10% additional tax on the $4,000. The correct answer is D. MEC distributions follow LIFO, so the first $4,000, the gain, comes out as ordinary income while the remaining $6,000 is a tax-free return of basis. Because the owner is under 59.5, IRC Section 72(v) imposes an additional 10% tax on the $4,000 taxable portion. Question 41. To be eligible to contribute to a health savings account, HSA, an individual must be covered by A. Any employer-sponsored health plan. B. A high-deductible health plan, HDHP, with no disqualifying other coverage. C. A health maintenance organization with a $0 deductible. D. Medicare Part A or Part B. The correct answer is B. Section 223 of the Internal Revenue Code requires an HSA-eligible individual to be covered under a qualifying HDHP and to have no other disqualifying health coverage. Enrollment in Medicare disqualifies a person from making new HSA contributions. Question 42. An A&H policy is reinstated on June 1st. The insured suffers a covered injury on June 2nd and is diagnosed with a covered sickness on June 7th. Which losses will the reinstated policy cover? A. Neither the injury nor the sickness. B. Only the sickness. C. Only the injury. D. Both the injury and the sickness. The correct answer is C. A reinstated policy covers accidental injuries from the date of reinstatement, but sicknesses are only covered if they begin more than 10 days after reinstatement. The June 7th sickness falls inside the 10-day exclusion window. Question 43. Under California law, before transacting any insurance business in the state, a person must A. Pass a background check only. B. Hold a license issued by the insurance commissioner. C. Register with the Department of Managed Health Care. D. File a fictitious business name statement. The correct answer is B. Section 1631 makes it unlawful to solicit, negotiate, or effect insurance in California without first being licensed by the Commissioner. A background check, live scan, is part of the application but does not by itself authorize transacting insurance. Question 44. An insured loses the sight in both eyes in an accident. Under a typical disability income policy with a presumptive disability provision, when do benefits begin? A. After the elimination period is fully satisfied. B. Immediately, with the elimination period waived. C. Only after the insured proves they cannot work. D. Only after Social Security approves a disability claim. The correct answer is B. Presumptive disability automatically treats certain catastrophic losses, including loss of sight in both eyes, hearing in both ears, the power of speech, or the use of any two limbs, as totally disabling. Benefits begin immediately and the elimination period is waived, even if the insured can in fact work. Question 45. An annuity is best described as protection against which risk? A. Dying too soon and leaving dependents without income. B. Living too long and outliving one's savings. C. Becoming disabled and losing earned income. D. A property loss due to fire or theft. The correct answer is B. An annuity is the mirror image of life insurance. Life insurance insures against dying too soon. An annuity insures against living too long, by converting accumulated savings into a stream of income that the annuitant cannot outlive. Question 46. Under a universal life policy with option A, type 1, how does the death benefit behave as cash value grows? A. Total death benefit rises along with the cash value. B. Total death benefit stays level, the pure insurance portion shrinks. C. Total death benefit shrinks at the same rate as the cash value grows. D. Total death benefit is unrelated to cash value because UL has no cash value. The correct answer is B. Option A, type 1, is the level death benefit choice in UL. As cash value grows inside the policy, the insurance company's net amount at risk falls so that the total death benefit paid stays the same. Question 47. After a life insurance policy has lapsed for non-payment, the reinstatement provision generally requires which of the following from the policy owner? A. Only payment of one current premium. B. Proof of insurability and payment of all back premiums with interest. C. A new application and a higher premium rate. D. Approval from the State Insurance Commissioner. The correct answer is B. To reinstate a lapsed life policy within the reinstatement period, typically 3 to 5 years, the insured must provide evidence of insurability and pay all overdue premiums plus interest. The original policy is restored rather than a new contract being issued. Question 48. An insured stops locking the car because she knows she has comprehensive auto coverage. This behavior is an example of A. A physical hazard. B. A morale hazard. C. A moral hazard. D. A legal hazard. The correct answer is B. A morale, attitudinal, hazard is the carelessness or indifference that arises because a person knows they are insured. A moral hazard, by contrast, involves intentional dishonesty such as planning to file a false claim. Question 49. A 50-year-old has been receiving Social Security Disability Insurance, SSDI, for 24 months. He is now eligible for A. Medicare based on disability. B. Medicare only once he turns 65. C. Medicaid only. D. Medigap with full underwriting. The correct answer is A. Persons under 65 qualify for Medicare after receiving SSDI benefits for 24 months. ALS and end-stage renal disease are exceptions that can qualify a person sooner. Question 50. Which of the following transactions is not permitted as a tax-free exchange under IRC Section 1035? A. Life insurance policy exchanged for an annuity contract. B. Annuity contract exchanged for a life insurance policy. C. Annuity contract exchanged for another annuity contract. D. A life insurance policy exchanged for a qualified long-term care contract. The correct answer is B. Section 1035 permits life-to-life, life-to-annuity, annuity-to-annuity, and, since the PPA of 2006, either contract into qualified LTC. Annuity-to-life is the one direction that is not allowed, because it would convert tax-deferred annuity gain into income tax-free death proceeds. That's all 50 questions. Want the full insurance practice test with hundreds of questions, completely free? Just search preppass.org. Good luck on your exam.